You probably just think of it as this classic green tech, right? A big, silent metal box sitting out in a field somewhere, soaking up solar power and, saving the planet. But if you actually look under the hood at how these systems operate in the real world, well, the reality is a whole lot more intense. These batteries aren't just passive storage boxes. They are highly complex, strictly profit-driven, high-frequency day traders operating at absolute lightning speed. Welcome to This Explainer. Today, we're going to look past all that green tech marketing and focus on the hard economics and operational realities of modern energy storage. We're diving into exactly how battery energy storage systems, or BESS for short, actually make money, the physical hurdles they have to overcome, and the incredibly complex algorithmic chess matches they play every single day on the power grid. Here's our game plan for today. We're going to hit the battery business problem, round-trip efficiency, revenue stacking, the Nordic chessboard, and finally, the costs of degradation. Let's jump right in. Section 1. The battery business problem, covering the commercial reality of BESS. Okay, so it's super tempting to think that making money with a massive battery is as simple as plugging it into the grid and just watching the meter spin. But the commercial reality is a lot less forgiving. Look, yes, the upfront capital costs to build these systems have definitely been dropping, but the payback periods on these massive investments, they are still stubbornly long. Plus, a battery can't just hold its capacity indefinitely, right? You only have so much energy to deploy, and once you're empty, you're totally out of the game until you recharge. Because of that limitation, every single operational decision, when to charge, when to discharge, when to just sit there and wait, has to be hyper-optimized. A wrong move doesn't just mean you missed out on some profit, it actively costs you money. Moving on to Section 2, round-trip efficiency, or the physics of energy loss. Before we can even start talking about making a profit, we have to understand how a battery physically leaks value just by existing and operating. And this brings us to a really absolutely crucial metric, round-trip efficiency, or RTE. Simply put, RTE measures how much energy a battery returns compared to the total energy you used to charge it in the first place. If you buy 100 megawatt hours of power from the grid and put it into your battery, you are never ever going to get 100 megawatt hours back out. The laws of physics essentially demand a tax on that transaction. So what's a normal rate here? Well, for modern lithium iron phosphate utility arrays, a healthy round-trip efficiency typically sits somewhere between 88 and 94%. Think about that for a second. That means in a best-case scenario, you are instantly losing 6 to 12% of the energy you paid for every single time you cycled the battery. So where exactly does that 6 to 12% actually go? There is a massive hidden cost hook here. Part of it gets lost to the battery cell's own internal resistance, sure. But more importantly, it's lost to the auxiliary systems required to run the battery itself. The inverters that convert alternating current from the grid into direct current for the battery, those cause a loss. And ironically, the battery literally consumes its own potential profits just to power its massive HVAC units, cooling fans, and safety equipment so it doesn't overheat during operation. This brings up a crucial point. Understanding the difference between DC and AC efficiency. There is a major misconception floating around the industry on this. Battery manufacturers absolutely love to quote DC efficiency, which often hits a very impressive 95 to 98%. But actually scratch that. That only measures performance at the bare battery cell level. Out in the real world, commercial projects use AC efficiency, which measures performance at the actual grid connection. Because AC efficiency has to account for the inverters, the transformers, and those power-hungry cooling systems, it drops down to around 85 to 92%. If you're out there modeling your financial returns based on DC efficiency, well, your project economics are going to be severely miscalculated. All right, let's get to the good stuff. Section 3, making money through revenue stacking. Now that we've accounted for those unavoidable physical losses, how do we actually overcome them and generate a real return? We use a strategy called revenue stacking. Now, the most obvious layer of this stack is energy arbitrage. This is your classic buy low, sell high play. You charge the battery in the middle of the night or during peak daytime solar hours when power is dirt cheap or sometimes literally negatively priced. And then you discharge it back to the grid during peak evening hours when everyone turns their ACs on and prices absolutely skyrocket. It's a solid baseline strategy. But remember, those round-trip efficiency losses and route-to-market fees eat directly into these spreads. So arbitrage alone, it's rarely enough to make the math work. To build a bulletproof business case, operators have to stack that arbitrage with frequency and balancing services. See, the power grid has to maintain a super strict frequency, around 50 or 60 hertz depending on where you live. If demand suddenly spikes or a power plant suddenly trips offline, the grid frequency drops and you risk cascading blackouts. So grid operators will actually pay battery owners substantial availability fees simply to be ready to inject or absorb power at a millisecond's notice. You're basically getting paid just for standing by and then paid again if they actually use your energy. Which leads us perfectly into Section 4, the Nordic Market Chessboard and Complex Grid Services. To really appreciate how intense this revenue stacking gets, let's look at algorithmic trading in one of the most advanced energy arenas in the entire world, the Nordic market. This perfectly illustrates the sheer, mind-bending complexity a battery asset has to navigate. When you look at the timeline, there isn't just one single energy market. A battery operator has to look at the day-ahead spot market a full 24 hours in advance, while simultaneously monitoring the fast-paced intraday market for minor adjustments. And at the exact same time, they're submitting bids into specialized regulation markets for frequency containment. It is quite literally a multi-layered chessboard. The software running the battery has to calculate overlapping timeframes, shifting spot prices, and the battery's current state of charge, just to figure out exactly which combination of markets will yield the highest profit in any given hour. So how does the battery actually play this game? Well, it follows a very strict chronological bid logic. Step 1. The algorithm submits a bid to the market operator, basically stating, hey, I can provide X amount of power at Y price. Step 2. If the price is right, the bid is accepted. And step 3. The battery must fulfill that promise. If the grid operator calls upon the battery, it must instantly deliver the exact amount of power it promised. No excuses. When you map out these binary decisions, submit or don't submit, accepted or rejected, fulfilled or failed, it reveals where the true danger lies. If a bid is accepted, but the battery fails to deliver, maybe because it didn't have enough charge or the hardware lagged for a second, the market doesn't just politely cancel the contract. Oh no. The operator incurs severe imbalance penalties. These penalties cover lost availability and imbalance charges. And let me tell you, they can easily exceed your initial revenues, completely wiping out your profits for the entire day. You are quite literally punished for overpromising. Section 5. The cost of degradation. Balancing wear and tear with profit. This brings us to the absolute climax of battery economics. We know how the battery loses energy, how it makes money, and how it navigates these crazy risky markets. Now we have to talk about the fierce tension between chasing that immediate revenue and preserving the physical battery itself over time. A recent technical study of the Nordic markets found a really fascinating dynamic. When you explicitly tell the software to factor in the physical wear and tear, the degradation costs of constantly charging and discharging, the algorithm fundamentally changes its behavior. It intentionally chooses to submit far fewer bids. It turns out, running the battery as hard as possible for every small sliver of profit actually destroys your long-term value. And this dynamic right here builds a winning financial strategy. If you compare a model that totally ignores degradation with a model that factors it in, the contrast is striking. The smart algorithm intentionally chooses to sit out of the market more frequently just to save the battery's health. Now, you'd think submitting fewer bids would absolutely tank your earnings, right? But by factoring in degradation, it drastically cuts operational costs and it completely dodges those massive failure to deliver penalties we just talked about. As a result, the algorithm sacrifices a huge amount of market activity, sure, but it only sacrifices a tiny, barely noticeable fraction of overall profit. So what is the grand takeaway for anyone looking at the energy storage business? The winning strategy is smarter, not harder. Intelligent, highly restrained bidding strategies mathematically outperform aggressive, always-on operations. Knowing exactly when to rest the battery is just as absolutely critical to the bottom line as knowing when to trade. You have to constantly balance the immediate lure of a nice price spread against the long-term electrochemical health of your multi-million-dollar asset. Which leaves us with this final, frankly provocative thought to consider. The physical battery itself, that's just the hardware. It's just the table stakes to get into the game. But as global energy markets become incredibly volatile and incredibly complex, success isn't necessarily going to go to the company that builds the biggest battery box. It's going to go to the operators with the smartest data science, the most restrained algorithms, and the absolute deepest understanding of market chess. Software, not just lithium, is the true driver of renewable energy profitability. Thank you so much for joining me on this explainer, and I really hope this completely changes